Covered call exchange traded funds or ETFs are one sort of investment that can provide exceptionally strong dividend yields to investors who have the goal of living off dividends as soon as possible in their lives. Covered call exchange traded funds are a relatively new type of investment that has gained a lot of popularity over the course of the past couple of years. This is how these exchange-traded funds operate. If you are not knowledgeable about the choices, it may be a bit difficult to comprehend, but they utilize a covered call investment strategy, which is when the fund buys a bag of shares and then also sells call options that correlate to that bag of shares. This can be a little complicated to comprehend if you are not familiar with the options. Each month, these options are put up for sale, and the premiums received from the sales are distributed among the investors in the form of dividends. And once more, we'll discuss covered calls exchange-traded funds or ETFs for today's video because there are so many advantages to owning them for investors who prefer to rely solely on dividend income. They provide investors with sky-high dividend yields, which are typically at least 7%, but which can occasionally even reach upwards of 13% during a storm drop. They distribute their dividends on a monthly rather than a quarterly basis, which is something that is usually more appreciated when one is investing for the purpose of generating income. In addition to this, the company is sufficiently diversified. The most common concern people have with regard to covered call exchange traded funds is the potential for long-term capital appreciation. People are fond of pointing out that the share price appreciation for covered call ETFs isn't nearly as good as it is for your ordinary S&P 500 index fund. This is something that people like to mention. There are a lot of people who will give you advice such as you should invest in index funds, wait a few decades for them to grow, and then once you are sufficiently older, move them into better dividend-producing assets. And the truth of the matter is that this is not terrible advice. Index funds that have been held for long periods of time have not led to financial ruin for anyone. Nonetheless, we do not advocate adopting this investment strategy on a personal level. The concept of dividend bull is centered on the concept of investing in order to retire as quickly as possible and live off of dividends. Also, to have greater flexibility to accomplish anything we choose with our lives, or at the very least, so that we can have adequate money to live comfortably. One major benefit of aggressively investing for dividends now, as opposed to investing for dividends decades in the future, is that this form of dividend investing is quite addictive. This is one of the major advantages of aggressively investing for dividends now. There are a lot of people in the world that purchase index funds, but for some reason, they can't bring themselves to continue investing in the stock market. It is quite challenging to continually acquire a load of shares of index funds in an account that is not designated for retirement and is doing so for decades until the account has accumulated enough money for retirement purposes. However, if you choose to invest in dividends in such a way that is aggressive, you are going to enjoy the sensation of watching each dividend payment being transferred into your money market account. Would even go so far as to suggest that this way of investing is arguably the type of investing that is the most addicting. You are going to be motivated to continue saving and investing if you are making huge dollars a month in dividends, because that huge amount will grow until it covers your mortgage loan, and then it will grow until it covers all of your monthly living expenses. However, we are aware that a significant number of you are either planning to open a retirement account in the near future or are currently very close to being eligible for retirement. If this is your situation, then covered called exchange-traded funds or ETFs are an excellent investment option that can provide you with a greater monthly income. This is true even if you do not have huge amounts of money set aside for your retirement. Welcome to Smart Stock Academy, where you'll discover videos about businesses and insights from your prominent CEOs. Thank you for joining us for today's video, and let's explore topics that will awaken your curiosity when it comes to stocks and investments. Make sure to like, share, subscribe, and click that notification bell to assure you that you'll be updated whenever we upload videos. In this video, we will go over what we consider to be the 3 most important covered call funds, make a comparison between the 3, and explain how we believe covered call ETF investors should approach these funds in order to maximize monthly dividend income. QYLD, JEPI, and NUSI are the 3 primary funds that we are discussing in this context respectively. According to the information that we have obtained, these ETFs are by far the most popular covered call funds that are presently accessible. In addition, there is XYLF, which focuses on the S&P 500 index, and RYLD, which employs options trading on the Russell 2000 index. Then there are funds such as QYLG and XYLG that strive to aim for growth as well as payouts in their investment strategy. However, the three that we're going to discuss are the ones that have the most number of users, with QYLD that has been around the longest and can be considered to have initiated the covered call ETF revolution. Taking a brief glance at QYLD, also known as Global X NASDAQ 100 Covered Call ETF, we can see that based on its data, as of the time of this video was produced, it presently possesses a dividend yield of 0.20%. A dividend yield of 10.73% is offered by the JP Morgan Equity Premium Income ETF, also known as JEPI. Lastly, the nationwide NASDAQ 100 Risk Management Income ETF, also known as NUSI, offers a dividend yield that is 7.51%. If we were to base our decision just on dividend yield, it would be easy to see that JEPI is the best option out of the three ETFs. However, investors who own these kinds of funds should be aware of some additional considerations that should be taken into consideration. The covered call ETF offered by JEPI as well as NUSI are examples of actively managed funds, whilst QYLD is an example of a passively managed fund. When an exchange-traded fund is actively managed, it means that the manager of the fund is personally responsible for selecting each and every stock that will be included in the ETF. Therefore, if some assets in the ETF are performing poorly, the fund manager should, in theory, consider changing the holdings in the ETF. It could also suggest that the fund management makes adjustments during bad markets in order to reduce the volatility of such ETF. This occurs when there is instability in the market. The question of whether or not actively managed funds truly perform better than passively managed funds has been the subject of an ongoing discussion, with some research coming to the conclusion that in the long run there is not much of a difference between the two types of management. On the other hand, QYLD is passively managed, which means that a fund manager is not responsible for selecting the investments that go into it. Instead, QYLD follows an index that is comprised of equities from the NASDAQ 100 and sells call options on those stocks in order to collect the premiums that are associated with those options. No one decides which holdings are included or in what proportions each holding is represented in the portfolio. Our research led us to discover that NUSI and JEPI provide downside protection in the variety of other ways as well. In the instance of JEPI, when we check at this fund's top 10 holdings in their website in 2021, there are companies such as Microsoft, Intuit, and Target. However, the 5 other holdings that together account for around 15% of JEPI's portfolio are known as equity-linked notes. ELNS are simple fixed income investments that are linked to equity investment. In certain respects, ELNS might be considered safer investments than other investments because they protect the principal. This means that the total amount of the capital is safeguarded in some circumstances. Considering that ELNS accounts for 15% of JEPI's portfolio, this particular factor has the potential to offer this fund some beneficial downside protection. When compared to NUSI, this covered call ETF offers protection in a manner that is distinct from the others. Not only does it employ protective puts on the securities in this fund in addition to writing covered calls in those holdings, but also utilizes protective puts on those holdings. A protective put functions similarly to an insurance policy in that it protects against potential losses. However, based on their data in 2021, JPI and NUSI are lower than those provided by QYLD. Nevertheless, we are able to observe their progression based on the data at hand. Even though QYLD's dividend yields are lower right now, they are really high in the past, and there is still a possibility that it will be upgraded once more. When we look closer at these funds and compare them with another one, we can see that all 3 of them are quite well diversified, which demonstrates that comparing them is a great idea. In 2021, QYLD holds 103 securities. JEPI has 101 securities in ELNS, and NUSI possesses 105 different securities. The bigger the number of assets inside the ETF signifies the more steady it'll be. Diversification helps by minimizing the risk. Another issue was comparing the expenditure ratios between these three ETFs. The cost ratio is essentially the annual price that you will be responsible for paying in order to hold a specific ETF. QYLD, which is the passively managed fund, has an expense ratio which is 0.60%. JEPI has 0.35% and NUSI has 0.68%. If we compare the performance of the share price of these three from the previous 2 years, JEPI is up about 18, while QYLD is up about 5.44 and NUSI is only up to 3.11. Even though JEPI is the newest ETF out of the three, with it just being introduced earlier, it's been the greatest performer over the last year in terms of share price appreciation and yield. In light of the previous information on these three funds, which covered call ETFs should we select to invest in? Or perhaps you are curious about our strategy when it comes to investing in these exchange-traded funds or ETFs. Because of the dynamic nature of both their data and their performance, it is unlikely that putting all of our money into one fund that offers the greatest dividends would be the most effective plan for the long run. To give you an example, let's say that QYLD was the fund that paid out the largest dividends the year before, but now JEPI is in that position. During periods of declining stock prices, the downside protection offered by index funds like JEPI and NUSI can be of great assistance to investors who are seeking to construct a dividend portfolio that will allow them to continue living off of their dividends regardless of the state of the stock market. Not to mention the fact that the growth in value of either of these two funds might actually come in helpful in a pinch if you ever find yourself in a situation where you have to sell something quickly. We propose dividing investments and allocating them to be held by QYLD, JEPI, and NUSI respectively. By acting in this manner, it will be known for certain that JEPI and NUSI will be advantageous in the event where there is a bear market. There is no other chance available for consumers to get such a high quantity of dividends each month, along with downside protection and yet experience capital appreciation. In addition, if you are an investor who is apprehensive about investing in QYLD, our recommendation to you would be to purchase either JEPI or NUSI because of the protection that they provide. That's it for today's video. Let us know what you think and leave it in the comment section so we'll know what your insights are. Again, make sure to like, share, subscribe, and click the notification bell for more updated videos about the business world.